Technologies is the stock on our radar. Remember, the company posted a rather strong set of numbers in the first quarter, partly aided by a low base. Their top line was led by a stellar growth in the consumer electronics as well as the lighting segment. And there was some improvement that we saw in working capital days as well. The big question is, what can they do in the coming year? Mr. Atul Lall, the MD of the company, joins us on the phone line to fill us in and give us a brief of what went on in the first quarter and what's the outlook going ahead. Hi, Mr. Lall. Congratulations on a good showing in the first quarter. Wanted to get a couple of numbers from you in terms of, the TV sales out there. I remember you talking about a million and a half in the past. For the first quarter, what was the total sales number? And for the year, what sort of a target do you have?
So in Q1, we did more than 500K, 0.5 million. In the Q2, the run rate is, I feel that we should be doing around 0.75 million.
Okay.
So that's a total of 1.2, 1.25 million in first half. And in whole 18-19, we've done around 1.1.
Okay.
So I feel that we should have a robust growth, and we should close in television at around 1.8 to 1.9 million this fiscal.
Okay, but you're expecting to clock in about 1.2, 1.25 million in the first half. So
that's right.
If you have to do a total of 1.8 million for the full year, which means you're expecting only about 0.6 million in the second half of the year, which is about 50% lower than what you've clocked in the first half.
No, I'm being slightly conservative. I feel that it's going to be more than that. Right. So one has to wait and watch how Diwali pans out. I feel that the kind of customer acquisition that we have done, and our anchor customer is doing extremely well in the Indian marketplace. They have already emerged as the largest smart television brand in the country. So I feel we are going to surpass the figure of 2 million, but let's wait and watch.
Okay. What about the lighting products business then? That's a relatively smaller part of your business. But out there, there was a stellar growth of more than 70% coming on a low base in terms of revenues. The margins as well improved a tad bit. But a quick question, the ODM share improved drastically. Then why didn't the margins improve at a faster clip?
So I think it has been basically because of certain raw material pricing issues. I feel that in Q2, we will have a significant margin expansion in lighting as well, because the operating leverage in this particular vertical also now has kicked in. So you'll see a fairly good margin expansion taking place in lighting vertical.
100, 150 basis points, 200 basis points. What should the expansion be? A rough range?
It's going to be sub that. It's going to be, I feel, around 80 bips.
80 bips is what you're going to look at. Okay.
Okay. What about back to the TV business? You're expecting a very strong growth for the full year in FY19. But is it on the back of higher discounting by a lot of, the TV players? And what is your own expectation on realizations for your company?
So you see, as far as the value growth is concerned, we grew 120% in Q1. Now, in Dixon's case, because we are primarily an outsourcing company, obviously we are linked to the final numbers in a particular vertical, that's how industry is doing. But in our particular case, it actually depends upon how our brands are performing. And I have shared earlier also that our main focus is on new customer acquisition and getting a larger pie of our existing customers. So I think our team has done fairly well in TV vertical in new customer acquisition. And our new customer is doing exceedingly well in the marketplace, which is triggering this kind of a growth.
Okay, all right. You've also been talking about backward integration in terms of the LCM, the SMT line as well, with regard to higher scale as well coming in there. What sort of a margin outlook can you give us in terms of a guidance for this year? I'm talking about blended margins. And what about top line growth as well for this year itself, the entire fiscal year?
You're talking about the entire company?
Yeah, the entire company, the entire consolidated entity. You've given very strong growth in the first quarter. But for the year, what sort of a growth should you look at in terms of revenue as well as in terms of margin profitability, that is?
So you'll see in both the financial metrics, you'll see a growth of around 35 to 40%.
35 to 40% in terms of revenues and margins in the first.
I'm not talking about percentage margin. I'm talking about the profitability numbers.
Oh.
No, just to clarify, Mr. Lall, in terms of revenue, what should the growth be in percentage terms?
It should be between 35 to 40%.
35 to 40% top line growth, that is revenue growth is what you're looking at. And in terms of margins, for the first quarter, you've done around 4.6%, that is blended margins. Now you're telling us lighting business, there'll be margin improvement there. There was some backward integration as well. So should the margins move up from this 4.5 to 4.6%?
So
we feel that the margin should go up to around 4.8, 4.9% on a blended basis.
Okay.
4.8, 4.9%. What about debt? We understand that your revenue is increasing very rapidly, but the debt also seems to have gone up. What does it currently stand at and your outlook?
Hello?
Yes. Atul, can you hear us?
Yeah, we can.
Okay, I'll just repeat the question. What about debt? What does it stand at currently and your outlook?
So if you see the long-term debt of the company, we are barely at 5 crores level. So there's no long-term debt at all. And if you see in Q1, the debt has come down significantly from around 90 odd crores to 56 odd crores in spite of the revenues going up. So we are focusing a lot on our operating cycle and working capital management.
Right.
So I will not allow the debt to go up beyond these levels.
I believe there's a big opportunity in the security systems business. If you could tell us what kind of a revenue number are you targeting in the security systems business for the entire year, and what was it in the first quarter?
So, security systems business, we have a partner which is the largest brand in India by the name of CP+. So it's a joint venture with them. This is a new business for us. The first quarter has been, because the base was practically nothing, has been very large growth. We get 50% of the share of revenue. So our revenue was somewhere in the region of around 65 to 70 crores in Q1.
Okay.
And this kind of run rate would continue. I feel the overall business will generate a revenue of around 500 to 550 crores. Out of that, our share would be half, 250 to 70 crores. Yeah, so this is a high growth vertical. Our partner is having the largest market share in India. So we are fairly bullish in this vertical. Yeah.
Okay. Just one question. You said that there was no debt. Your working capital improved as well. But why was your finance cost then 10 crores in the first quarter?
This is primarily because of the higher discounting charges. You see, in our Xiaomi business, the interest cost is being reimbursed to us as revenue. It's a part of a value addition, right? But as per the accounting norms, we are showing it there.
Okay.
Overall working capital has come down.
So on a quarterly basis, we'll see 10 crores per quarter. Is this sort of discounting likely to continue, or do you believe that was just a one-off quarter?
No. This is going to continue.
So every quarter we'll see 10 crores because of the discounting matrix that you're explained to us. Because of that, 40 crores for the year will be the finance cost.
That's right. That's right.
All right. Atul, we'll leave it at that. Thanks so much for joining in. So this Dixon Technologies see good growth in all its key verticals, whether it's the TV business or the consumer electrics or the lighting product business. They expect margins to expand to 4.8, 4.9% for the full year. And the top line revenue growth should be close to about 35 to 40%. But that also, I guess, the company is being quite conservative. Let's move on for the market.